Joining us now for a first on CNBC interview is Bank of America Chair and CEO Brian Moynihan. Brian, thank you for taking the time on what is a very busy day for you. Highest quarterly EPS in decades, thanks to the Wall Street side of the business. How sustainable is that boost? At what point does the volatility that really helped equity trading create a bigger headwind for some of the other businesses you have?
Well, thank you for having me. The EPS was up 25% year over year, so it was a great quarter. But also, if you listen to what we talked to the shareholders about today, it's across all the businesses that are performing well. So yes, equities was up, but if you think about the $30 billion plus revenue we produced, it came from all the businesses. So the nice news about Bank of America, if that volatility goes away and those revenues flatten out in terms of growth rate, other areas will pick up the slack and grow faster because the dynamics of that probably means somewhere else is doing well. So that's a nice thing about having this very wide-ranging business model, from mass market consumers to the wealthiest consumers, people in the world, small business, large businesses, domestic and global, the markets business, investors of all sizes. And so having that diversity, it allows us to perform in really different types of markets. So we're very pleased with the job the markets team did, up 15 straight quarters year-over-year growth, this time driven more by equities. We're pleased with that. But on the other hand, whatever comes at us, we're well prepared for.
On the call, you announced that you were bumping up your net interest income guidance growth, while your peers either maintained theirs or, in one case, even lowered it. Why do you feel confident to raise, given the macro backdrop, given all the uncertainties out there, flattening yield curve? I know your mix is a little different than some of your peers.
Yeah, the power of our NII is driven by our core deposit franchise, which grew 3% year over year. It's the rate paid on deposits because our core operating accounts, we're not reaching for funding that others are, meaning paying at the market pricing because we don't need the funding. We have $2 trillion in deposits and $1 trillion in loans. So that's the core value. And that then performs well in any rate environment. It continues to perform well. So we had originally 5 to 7% NII growth predicted for this year, which is an outlier on a positive way relative to our peers. And then we moved that to 6 to 8%. And in first quarter, we actually had nice growth at 9%. So we feel very good about that. Does it depend on strong macro conditions? No, it depends on 2% type of GDP growth, mid-single digit loan and deposit growth, just bumping along. But the massive repricing of the balance sheet as this engine keeps producing is really something phenomenal to watch. So we were up $1 billion plus in NII year over year, to give you a sense. It's more than most companies were.
So it sounds like this is a pretty conservative raise then.
Well, you raised, and I heard some of your colleagues talking before, you can raise whatever parade of difficulties out in the world, from the Middle East conflict, resolving the inflation prices caused by that. The economists can argue long-term inflation, short-term inflation, whether it should be excluded or included. But the reality is prices go up. You can see that the uncertainty around all that is causing some activity. So you can't ever say the world is perfect ahead. But right now, the company's performing well. The consumers are spending. The credit quality is very good and improving, and you see that corporate clients actually use their lines a little bit more. So we all face that same uncertainty, but right now the U.S. Companies and consumers are doing well, and frankly, our global companies are doing pretty well.
Do you feel like the consumer is poised to accelerate? I know there was some commentary on that from the call. I hear that, and then I see that the net charge-off ratio worsened a little bit since 4Q, although it was improved from a year ago. It does also appear that most of the deposit and loan growth came from the commercial side. So I'm just curious, what you're seeing with regard to the consumer and whether we are indeed at this inflection point.
The consumer delinquencies of all types were down year over year, and there's a seasonality. Most of our credit quality discussion is driven by the credit card business, which grows in the fourth quarter, and then you have a dynamic that it comes down. But if you look first quarter last year to first quarter this year, loan balances grew 3%, charge-offs were down, delinquencies are down 5 and 30 and other delinquencies. So the consumer credit quality of our portfolio is actually improving. If you go back and think about the travel over the last 5 or 6 years, we saw this massive drop in charge-off rates due to in COVID, because frankly people didn't have the ability to go out and spend a lot of money and the supplements their income coming from the government. We saw that normalize back up, and many of you asked us a year ago or the year or so, when's it going to, are you sure it's going to stop? Well, it not only stopped, it's flattened out and actually come down a little bit. So we feel very strongly that the consumer book at Bank of America is very strong, and at the high FICOs, the loan to value on our entire mortgage portfolio is below 50%, and then our autos FICOs are high FICOs, and the delinquencies are consistent. So we feel very good about the book. What is going to happen next to the consumer will depend upon unemployment. And if you watch for new claims for unemployment, they're basically very low. The unemployment level sits 4.3, 4.4, depending on the month. The blue chip and our own analysts don't predict it to go up a lot. And as long as that's true, the general economy will be in good shape, and the general consumer will be in good shape. But Bank of America indexes even to higher quality, so we'll be even in better shape.